Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us understand today ratio analysis. See, ratio analysis means it helps us to understand the relationship between the two variables in the mathematical terms. So here you can see the quantitative method. Quantitative means in numbers we are understanding. So gaining the insight into company's liquidity, operational efficiency and profitability by studying the financial statements of the company. Financial statements means balance sheet and the income statement. So ratios can be in the form of fraction, rate or times, pure ratio or proportion or percentage. Okay. How we are doing the analysis? The ratio analysis can be done in a two way. One is cross-sectional. Here we are comparing the company's information, company's data with the other companies. So comparison will be done with the other company's financial statements. Under time series, we are comparing the company's data, previous data with the current year data. That is past and the present we are comparing. Okay. And why the ratio analysis is important? See, ratio analysis is very important. It helps us to understand the what is the past ratio and the current ratio. And the current ratio means current situation or position of the company, and helps us to take an average of the similar industries. Then the last one is under ratio analysis will follow rule of thumb. So what do you mean by rule of thumb? Means there will be a certain conditions. Example, for current ratio always it should be in a 2:1 form. This is called ideal ratio. For every two current assets, there will be one current liability. Okay. For quick ratio, it should be in a form of 1:1. Now we'll understand the types of ratio. Types of ratio. Totally, there are four types of ratio. The first one is liquidity ratio. Liquidity ratio. See, liquidity ratio helps us to understand how we can meet the short-term obligations, the debt repayment capacity without generating outside debt. Whatever assets we have inside, so using that how we can repay. So that is liquidity ratio, liquidity portion. In a short term we are understanding, that is very important. Short term within 12 months. Within 12 months. So this is about the liquidity ratio. Then we have solvency ratio. We are studying each ratio in detail. Solvency ratio. Then we have turnover ratio, and the last one is profitability ratio. So first we will understand, so what is liquidity ratio? The liquidity ratio helps us to understand the short-term position, short-term repayment capacity. Liquidity ratio. Here, the liquidity ratio we can divide it into two forms. The first one is current ratio. Current ratio or working capital ratio. Working capital ratio. So what do you mean by working capital? How you are finding working capital? Working capital means current assets minus current liability, right? So here to find out the current ratio, the formula we are using is current assets divided by current liabilities. The other one is quick ratio. Quick ratio. Note down with me. Take pen and paper, take pen and book. Write all the formulas you have to write first. Liquidity, liquidity ratio, quick ratio or liquidity ratio or acid test ratio, immediate reaction, right? So that's why it is called quick ratio. Immediately within 6 months you can convert, within a short period of time, how you can repay the debt. Acid test ratio. Now first we will understand the current ratio. The current ratio, ideal current ratio is always it will be in 2:1. If it is in 2:1, it is good position. Okay. Then some of the items we won't consider under the current assets. So which are the items are excluded from current asset? Excluded from current assets. The first one is loose tools. This also comes under inventory or stock, but we are not going to consider loose tools under current assets. And stores and spare parts, space. Last one is provisional for doubtful debt. For doubtful debt. Yep. So these are the items we'll exclude from the current assets. What is the ratio for calculating current ratio? Current ratio is equal to current assets divided by current liabilities. Now we'll understand the quick ratio or liquidity ratio or asset test ratio. The formula for quick ratio is quick asset divided by current liabilities. You don't have any quick liability, okay? Current liabilities only you are taking, only the changes will be made in the assets. So quick assets. So how you are finding or calculating the quick assets? Quick assets is equals to current assets minus inventory. Inventories is also called as stock. If stock is given, that you need to deduct from the current asset. Not only the inventories, prepaid, prepaid expenses and advance tax. These three items we are deducting while calculating the quick asset from the current asset. Current assets minus inventories, prepaid expenses, advance tax. So the what is the ideal ratio for quick assets or quick ratio is 1:1. 1:1. Now let us understand by solving this question. Okay. So here calculate current ratio from the following information. We'll calculate with the same data the quick ratio also. So your details are given about inventory, trade receivables, advance tax, cash and cash equivalent, trade payable, short term borrowing, that is bank overdraft is given. So what is the formula to find out current ratio? Current ratio is equal to current assets divided by current liability. Now first we will find out the current assets. So current assets are inventories, trade receivables, advance tax plus cash. So these are all coming under the current assets. Trade payables and short-term borrowings are coming under current liabilities. So what is the amount of inventory? 50,000 plus trade receivables is also 50 plus advance taxes 4,000 plus cash is 30,000. Total is 1 lakh, 1,34,000 is our current asset, right? 1,34,000. Now let us find the current liabilities. So current liabilities are trade payable plus bank overdraft. So trade payable is 1 lakh plus BOD is 4,000. Total is 1,04,000. Now current assets divided by current liability. Current assets is 1,34,000 divided by current liabilities is 1,04,000 is equals to 1,34,000 divided by 1,04,000. 1.2. 1.2. This you can round up. 1.288 is there. So to 9 you can take it is to 1. So this is the current ratio. Now we'll find out the quick ratio. Quick ratio is quick asset divided by current liability. So what is the meaning of quick asset? From quick asset, total current asset minus inventories, then advance tax. Advance tax and one more item what we are deducting. That is, see here, inventories, prepaid expenses and advance tax. So here prepaid expenses is not given. Right, only we have inventory and advance tax. So what is our total current asset? Total current asset is 1,34,000. Out of this, minus inventory is 50,000 and advance taxes 4,000, right? 4,000. 1,34,000 minus 50,000 minus 4,000. 80,000. 80,000 is quick assets. Now we'll find out 80,000 divided by current liabilities is 1,04,000. 80,000 divided by 1,04,000 is 0.77 is to 1. Right. See, always the ideal ratio of quick ratio is 1:1. 1:1 is safe. If it is low, it will be risky. If it is high, it really leads to an unnecessary deployment of assets. Okay. Now let us understand the next type of ratio. What is the second type of ratio? That is solvency ratio. Solvency ratio. Under solvency, totally we have 5 types of ratios. The first one is debt equity ratio. Debt equity ratio. See, debt equity ratio helps us to understand the relationship between the equity and the debt. When the equity is more, it is called favorable condition. The debt should be less. If the equity is decreasing, that may leads to bankruptcy also. So that's why we are understanding here relationship between the capital structure, you can call. The formula to find out the debt equity ratio: long term debt divided by equity or shareholders fund. Shareholders fund. So what are all the long term debt includes here? The long term debt is equals to long term borrowings plus any other long term borrowings and long term provisions. Long term provisions. So here the debt is all long term borrowings, other long term borrowings, any other long term provisions is there. All long term debt we are considering to calculate the debt equity ratio. And to find out the shareholders fund or equity. Equity or shareholders fund. is equals to share capital plus reserves and surplus plus any money received against share warrants and preference capital. Share capital includes both equity and preference shares. Okay, so that we are taking under the shareholders fund. In case so these share capital, reserves and surplus, money received, preference share capital is not given, then we have another way to find out the equity or shareholders fund or shareholders fund, that is with the help of non-current assets plus working capital minus non-current liabilities, then we will get the equity or shareholders fund. So what are the two way? One, by adding share capital, that is preference share and equity share, reserves and surplus, and any money we are received against the share warrants, or by adding non-current assets with working capital and deducting the non-current liabilities, we can find the debt equity ratio. And the debt equity ratio, it is safe when they have 2 is to 1. 2 is to 1. So more than this will be risky. 2 is to 1 will be safe. Okay. The next ratio under solvency ratio is total assets to debt ratio. To formula to find out this is total assets divided by long term debt. Then the next one is proprietary ratio. Formula to find out the proprietary ratio: equity divided by total assets. So under solvency ratio we have two more ratios, that is interest coverage ratio. The fourth one is interest coverage ratio. The formula to find out the interest coverage ratio is profit before interest and tax divided by interest on long term debt. So interest coverage ratio, we have one more formula, that is fixed interest charge. Interest coverage ratio is equals to profit before interest and tax divided by fixed interest charge. So we will get profit before tax, that is profit before interest and tax. From this less interest, we'll get profit before tax. Then from this, if you deduct, you will get profit after tax. So PBT is equal to profit before tax is equal to profit after tax into 100 divided by 100 minus tax. Okay. The last one is debt to capital employed ratio. Debt to capital employed ratio. Debt to capital employed ratio. The formula is debt divided by capital employed. Debt divided by capital employed. To find out capital employed, we have two methods. We have two methods. The first one is asset side. The second one is liability side. Liability side. Under asset side, non-current assets plus working capital. Working capital. Working capital means current assets minus current liabilities. Then we will get capital employed. Under liability side, shareholders fund plus non-current liability. Non-current liability we are adding. Then you will get capital employed. Right? So let us solve one question under solvency ratio. To understand this solvency ratio. In this question, the details of assets and liabilities are given. So they asked us to find out the debt equity ratio. So let us find out first debt equity ratio. What is the formula for debt equity ratio? Debt divided by or long term debt divided by equity or shareholders fund. This is the formula. So first we will take the debt. What are the details are given under debt? So here we have long term loans and advances. Then current investment, inventory, trade, these current assets we are not going to touch. So we are taking only the current liabilities. That is long term borrowing, other long term liability, long term provision. Here we have non current liabilities. 4 lakh plus 40,000 plus 60,000. So these three we are going to consider for debt calculation. Long term borrowing plus other long term liabilities plus long term provisions. Right. So long term borrowing is 4 lakh plus other long term is 40,000 plus 60,000 is provision. So total debt is how much? 5 lakh. Then equity. Equity means shareholders fund. We have all the capital. Share capital we have here. Right. Share capital, reserves and surplus and money received against the share warrant. All these three we are going to consider for the equity. Share capital plus reserves and surplus plus money received against the share warrant. So what is the amount? 12 lakh plus 2 lakh plus 1 lakh. Total is 15 lakh. 15 lakh. Now we'll find out debt is 5 lakh divided by equity is 15 lakh. Equity is 15 lakh. 5 lakh divided by 15 lakh. Right? 0.33. 33:1. So this is the debt equity ratio. Then we'll find out the ratio of debt to capital employed. Debt to capital employed is, what is the formula? Total debt divided by total assets. So in the same question we'll solve this capital debt to capital employed ratio. So total debt already we have, that is 5 lakh. For debt to capital employed ratio. Employed ratio is debt divided by capital employed. Capital employed. Net asset we can take it. So debt is how much? It is 5 lakh. Total debt is 5 lakh. And capital employed is, here we can take it asset side also or the liability side also. Let us take asset side. So asset side we are taking all non-current assets. So these three are non-current assets. From this we are taking the current assets minus current liability, that is working capital. So capital employed is equals to non-current asset is, total of non-current asset is 15 lakh plus 2 lakh plus 1 lakh. Right. From this we are adding working capital. Working capital means what? Current asset minus current liability. So current assets is given. So what is the total current asset? Current asset is 1,50,000 plus 1,50,000, 1 lakh, 2,50,000, 50,000. Total 7 lakh current assets ಇದೆ. ಇದರಲ್ಲಿ ಕರೆಂಟ್ ಲಯಬಿಲಿಟೀಸ್ ಏನಿದೆ ಮೈನಸ್ ಮಾಡ್ಕೋಬೇಕು. ಕರೆಂಟ್ ಲಯಬಿಲಿಟೀಸ್ ಎಷ್ಟು? 2 plus 1 3, 3 lakh 50, 4 lakh 5 lakh, minus 5 lakh, minus 5 lakh. ಎಷ್ಟಾಯ್ತು? ವರ್ಕಿಂಗ್ ಕ್ಯಾಪಿಟಲ್ 2 lakh ಆಯ್ತು. ರೈಟ್. ನಾವು 15 plus 2 plus 1 is 18 lakh plus 2 lakh is 20 lakh. 20 lakh is capital employed. So what? Let us find out the debt to capital employed ratio. 5 lakh divided by 20 lakh. 5 lakh divided by 20 lakh is 0.25. Istu 1. Understood? So what is the next ratio? We need to find out. Next ratio is total assets to debt ratio. Debt ratio. So what is the formula? Total assets divided by long term debt. So total assets is to, total assets means it includes both the current and non-current assets. So 25 lakh, 25 lakh divided by long term liabilities is to, long term debt, that is long term debt ಕೊಟ್ಟಿದ್ದಾರೆ, non current liability, that is long term borrowing, other long term liability, long term provision. So 4 plus 40 plus 60 is 5 lakh. 25 lakh divided by 5 lakh is 5 is to 1. 5 is to 1. Right. The next ratio is proprietary ratio. Ratio. What is the formula for proprietary ratio? Equity divided by total assets. So what is equity here? Equity means all these three: shareholders fund, share capital, reserves and surplus, money received against share warrants, all these three we are going to consider. and if preference share is there, that also you need to add it. So total is 12 plus 2, 14 plus 1, 15 lakh. 15 lakh equity divided by total asset is 25 lakh. 15 lakh divided by 25 lakh. 0.6:1. So this is the proprietary ratio. And the last one is interest coverage ratio. Interest coverage ratio. For interest coverage ratio, formula is profit before interest and tax divided by fixed interest charged. Interest charged. Fixed interest charged. Now let us take this example. So calculate interest coverage ratio. Net profit after tax is 60,000. 15% long-term debt is 10 lakh. So always they will mention the rate of interest with the name of the debt. So your interest rate is 15% and tax rate is 40%. What is the formula? Profit before interest and tax divided by fixed interest charge. So let us calculate now. So first, what is the details is given, that is net profit after tax is given. After tax is how much? Rupees 60,000. What is the tax rate? Tax rate is 40%. Now we need net profit before tax. So we will find out net profit after tax into 100 divided by 100 minus tax rate. So net profit after tax is how much? It is 60,000 given in the question, into 100 divided by 100 minus the tax rate is 40%, minus 40. So 60,000. Here we already deducted this 40%. Now we want to get this 100. So that's why we are doing the reciprocal. Okay. 60,000 into 100 divided by 60. Let us calculate. 60,000 into 100 divided by 60. It is 1 lakh. 1 lakh. Now we want interest. So what is the interest? Interest is equal to 15% of rupees. Long-term debt is 10 lakh. On 10 lakh, 15% means you'll get 1,50,000 interest. Right? 1,50,000 is interest. Now, net profit before interest and taxes. Net profit before taxes plus interest. How much net profit before tax? It is 1 lakh and the interest amount is 1,50,000. So total 2,50,000. Now interest coverage ratio. What is our net profit before interest and taxes? 2,50,000 and fixed interest is 1,50,000. Here 2,50,000 divided by 1,50,000. 1.67 times. Always interest coverage will show it in times. Okay. And 6 to 7 times if it is coming, it is considered as safe. Okay. I hope you all understood. The remaining ratios will continue in the next class. Have a great day. If you are not yet subscribed, kindly subscribe the channel. Press bell icon to receive updates.